Welcome to Policy on Demand. I'm Sindhu Blume. Much anticipated foreign tax credit guidance, or an announcement of future guidance, was issued December 11th in a notice from the IRS. Notice 2380 addresses three different aspects of the FTC and other rules. Here to talk about those three parts and what they mean for you are Wade Sutton and Elizabeth Nelson. Wade and Elizabeth, welcome.
Good to be here.
Thanks for having us.
So, Elizabeth, let me start with you to talk about an overarching statement about this notice and its intention. And taxpayers have been looking for some direction in this area. So does this notice provide that?
It does provide some certainty. It's got three sections to it. It talks about the credibility of Pillar 2 taxes, DCLs or dual consolidated losses, and foreign use with respect to the Pillar 2 regime, as well as providing an extended relief period for FTCs under Notice 2023-55, which was previously issued to give relief for foreign tax credibility analysis. So some certainty and certainly the direction the government's going with respect to those items.
Great. Well, let's get into the three parts. And Wade, let me start with you. There's the Pillar 2 relief, the DCL, and the FTC. Let's start with Pillar 2.
Sure. And this is going to be a little bit technical, so my apologies. But first, let's talk about what sort of taxes are imposed under Pillar 2. There's the IIR, income inclusion rule, and that's sort of a top-down tax similar to a CFC regime. That will apply next year, 2024. Then there's the UTPR, under tax payments rule or profits rule. That applies in 2025, and that's where, if it's not picked up under an IIR, you can go look elsewhere in the group and tax those profits. And then finally, there's this qualified domestic minimum top-up tax, QDMTT. And that's where a local jurisdiction can just jump to the front of the line and say, hey, instead of letting another country impose tax on my low tax profits, we're going to collect the top-up tax in accordance with the GLOBE rules. So what the notice does is it only provides guidance on the IAR and the QDMTT. It doesn't say anything about the UTPR in terms of creditability. If I had to guess, we'll later find out that those are not credible, but they just didn't get into it. And maybe that's because we'll learn in the future that it's not even an income tax that could be creditable. So the other two types of taxes, the QDMTT, that is going to be creditable, right? There's this concept of a final top-up tax, and that's where if taxes on the owner of the entity are taken into account in determining the amount of tax down at the entity, then those are not credible. Well, QDMT doesn't do that, so that's fine. But the IIR is generally not going to be creditable, right? So a lot of our clients might have, for example, a UK holding company that might own a low-taxed entity, and that'll apply an IIR in 2024. That's not going to be credible. The reason for that is the government wanted to avoid circular calculations, right? Because guilty, if those were creditable taxes, would apply by reference to the IR and vice versa. And so that circularity would kind of go on forever. So to shut it off, the taxes are not credible and they're not deductible. And this is not surprising necessarily for folks that read a New York State Bar report over the summer. But it was a little broader than I think a lot of people were expecting. The fact that you can't deduct the taxes, you still suffer what's called a Section 78 gross up. That surprised some folks.
I think the mechanic of it is what is surprising, because they say it's an income tax at the entity level, and it gets picked up and you have a Section 78 gross up, so you don't have a deduction, but then it gets denied, the credibility gets denied at the US group level, which I think was surprising.
And that's unusual because in general, if you have a foreign income tax, you can claim a credit, full stop. And where you still suffer the Section 78 gross up and you have the inclusion and it's deemed paid and you can't claim a credit, there's usually a statutory provision that says that. And that's not really spelled out in the notice here.
Okay. Elizabeth, DCL relief.
So DCL relief, they talked in the notice about the issue, which is foreign use of dual consolidated losses, but under the Pillar 2 regime. They did give a hint, I think, of potential safe harbor that they might allow for, looking to whether or not the DCL impacts your jurisdictional ETR, your effective tax rate. And if you do a calculation with and without the DCL and it's the same, like you still meet the 15%, then potentially, I think they signaled a little bit in the notice that that might be an area where they would give relief. What they did give was certainty with respect to what they're calling legacy DCLs. And those are dual consolidated losses that were incurred in tax years ending on before or on December 31st, 2023, or for fiscal years that are consistent with your Pillar 2 fiscal year, that begin before January 1st, 2024, but after December 31st, 2023. So a little bit of certainty for taxpayers, because there was a concern if there were timing differences that you would then have a triggering event with respect to those losses, and you would have to pick those up on returns, once Pillar 2 came into effect. So you shouldn't have to do that if they provide the relief they're talking about in the notice. The only kind of anti-abuse rule that they've signaled is with respect to DCLs that were entered into or incurred to mitigate jurisdictional top-up tax.
Okay. Wade, FTC relief.
Yeah, so over the summer we got an extension, we got a notice providing relief that said you can go back to the pre-2021 foreign tax credit regulations, which used a predominant character standard to determine whether or not you could credit a tax. And there were some modifications for certain gross basis taxes, like DSTs, to ensure that those were not creditable. But for the most part, that notice over the summer took a lot of the pressure out of the foreign tax credit space. There were a lot of debates about services withholding taxes, or certain taxes in various countries that might or might not be creditable. By going back to the old set of regulations, I think all those debates have quieted down. And as we were getting closer to 2024 and the relief was going to expire, or maybe it had already expired for certain fiscal year taxpayers, there was a big call to say, hey, we need more relief. We're not ready to go back and implement these regulations. And so what this notice does is basically extend the relief indefinitely. Now, it's worded in an interesting way, because it's extended until a year that ends, let me get this right, before guidance specifying what the new rules are going to be. And so I think the immediate call I've gotten from a number of people is, well, what happens if I'm sitting there in December of 2024 and new regs drop that say, by the way, here's the new set of foreign tax credit rules? Does that undo all the relief for 2024? So I think, yes, that theoretically could happen. I'm guessing that was not the government's intent here. I think this is just, buying some breathing room till they'll take it up in a future date and hopefully do it prospectively.
Right. So Elizabeth, let me come to you for the last question. I know that this notice talks about future guidance, but I'm also curious about what other guidance we can expect now that we are at the end of a year.
So I think certainly under the notice and going forward, we can expect foreign tax credit credibility regulations that are proposed and proposed DCL rules. I think in the DCL space, and what wasn't discussed in the notice, there are a couple of items on the priority business plan, inclusions on stock and intercompany debt, that presumably will be addressed in guidance, which are going to have an important impact, I think, on the foreign use issue with respect to DCLs. And so I think we can expect to see both of those, in addition to credibility of Pillar 2 taxes that'll be included in those foreign tax credit regulations.
And timing?
Timing, I don't think we're going to see anything before next year and late in the year.
Okay.
And we should mention, there's a presidential election.
Yes.
Right. So we could see a long hiatus in the foreign tax credit space. I guess Pillar 2 taxes, you have to answer that question. But the bigger package, I could see that slipping.
Yeah.
Okay. Any other guidance on the horizon?
And I think we're expecting a CAMT notice, and maybe Wade can weigh in more on that.
Potentially. So there's so many rumors about, are they going to get guidance out by year end? Is that going to slip until January? But I am hopeful that we'll get some, this double counting issue people talk about all the time, where the CFC's earnings might be taxed twice under CAMT. I think we are hopeful that gets out by the end of the year, as well as some stuff maybe on the excise tax, and who knows, maybe something on PTEP, like a notice there. We'll just stay tuned, keep your eyes open.
Okay. All right. Wade, Elizabeth, thank you so much.
Thank you.
Thank you.
And as is known to happen when one year turns into the next, governments and other organizations are getting guidance out the door. We're keeping an eye on policy developments in and outside the United States, and we'll bring those to you when they happen with analysis. Until then, thank you so much for spending this time with us. Take care.